The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Friday morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN just after 9 a.m. Eastern Time. It's been quite a week, but we got one more trading day left, and we got some volatility kicking things off. Some of the banks getting bailouts. They're trading lower this morning. Is that not enough? We will find out on the opening bell, man. But you got Credit Suisse trading a little bit lower. You got First Republic trading lower. Yeah, the fear not subsiding, and it would make sense, right? Seems like the Fed is a little worried, man. Some of the numbers of the dollars that they are throwing behind these banks seem like they're ramping things up to make sure if there is a run that they are protected. But boy, if there is a run, you really can't protect it in terms of the amount of numbers that we're talking about here in terms of the banks and the systematic pressure that they're going to face as they're holding fixed income on their books that has taken a hit in terms of the market cap. But this morning, a little bit of volatility, man. We trade down 50 points in the S&Ps from where we were at 4:30 in the morning. We just make a low below 39.60. We're catching a small bounce right now up to 39.71. NASDAQ 100, you're only down by about 0.1%. Man, how about some of those FANG stocks yesterday, right? NVIDIA, Apple, Amazon, all the growth stocks charging higher. Dow off 245 this morning. We got the Russell off another 1.4% this morning. Bitcoin catching yet a bid yet again up to 27,155 overnight. We're sitting at 26,835. Crude down another dollar below $68. Crude trading at 67.47. We jump over to gold. The run is not stopping, man. Okay, that's the thing to pay attention to, right? You look at crude is lower. Gold is higher. We jump to notes and bonds. What do we got? Today we got higher price and lower yield right now, reverberating a bit to where we were yesterday, kind of reversing what we saw yesterday. It's going to be an interesting open, quite a week, quite a market, right, to say the least in terms of where we are right now. We jump over to the volatility index as we got some volatility in spades, as my dad would say. VIX just hit 25, backing off a bit to 24.39 as the market rolls over a bit at 39.68. We got to talk about some currencies, man. You check out the dollar index, right? Quite the move this week. From 103 and change to a 105 handle. We just had a 103 handle this morning. We're back to 104.19 right now in the dollar index. And yeah, let's jump around to some of the headlines. And I think this one surmises it best. Credit Suisse shares fall as investors remain wary. What is their symbol? Is it Credit Suisse CS? Is that what pulls it up? Yes, it is. So there's the action, right? You see the volatility on Wednesday. The central bank steps in. We get some calm yesterday, but boy, just like that, man, you're down another 16 pennies right now for Credit Suisse. You jump over to First Republic. I don't know, folks. It doesn't really make sense that you got a stock like First Republic down 20% from the close of action yesterday when they got a $30 billion bailout from the big banks. I think they have about $270 billion in assets, and $30 billion versus $270. Not really going to protect them if there is a run on that bank. And that's probably what you have a few investors saying. Would you be parking your money at First Republic right now, even after what happened yesterday, if you had 500,000, a million, 10 million, 100 million in that bank? I would not be doing that. Doesn't matter what the big banks did yesterday. The problem with people keeping their money in banks is that there is such a risk-reward profile that is skewed. There's almost no reward keeping your money in one bank versus the other. I'm exaggerating. There are obviously some rewards in certain areas of banking and relationships that exist, but there's almost no advantage of one bank versus the next when you think about the risk that you face if one bank might go BK and the other one will not, right? Is it worth the risk to keep your money in First Republic when you think you might lose it all as opposed to keeping it in another bank? I don't think there is, and I don't know how that survives, and I don't know how Credit Suisse survives with the heat that they're facing right now in terms of just the fact that everybody, it's almost become a joke, right? Credit Suisse. How do you overcome this type of hysteria on this stock, regardless of the backstop from the central bank? It'd be interesting to see how that plays out in terms of UBS, Credit Suisse. Do they do a takeover? Do they combine? How does that happen? I was talking to one of my best friends over in Switzerland this morning. He works for UBS. Very fortunate that he works for UBS versus Credit Suisse. But he was saying, folks, okay, It's not good, period. Even for people working for UBS over there, which is a very strong bank, not good. The whole Swiss banking right now, kind of a black mark. And you see how that's reverberating across our banking system in the U.S. as well. And boy, we got a whole day of trading. We're going to see where we go. But that's the headline, man. We're going to see where we go. But Credit Suisse shares falling. First Republic. Yeah, how about the First Republic execs? My dad was talking about this yesterday, selling $12 million in stocks in the months before the crash. All right, what else are we going to jump? So Credit Suisse gets a $54 billion lifeline. Now it must win back clients. That's the tough enough part that, and I don't want to say no one's talking about, but how does that happen? How are you going to win back clients from Credit Suisse? I just don't see how it happens, man. I don't see how First Republic, I don't see how any of these banks, once there's a question of survival, I don't know how that happens. Now, let's jump to this story, man. I think I already have it pulled up, but boy, you got to see these numbers, man. You talk about worry in the market, all right? I keep keeping my eye on it with 18 minutes to go until the opening bell right now. Banks borrowed, you get this number, folks, $164.8 billion from two Federal Reserve backstop facilities in the most recent week, a sign of escalating funding strains in the aftermath of SVP's failure. So data published by the Fed showed $152.85 billion at the discount window. That is the traditional liquidity backstop for banks in the week ended March 15th. So that was last week, okay? A record high, up from $4.58 billion the previous week. The previous all-time high was $111 billion, reached during the financial crisis. You want to take a look at what that looks like on a chart, folks? We're in especially interesting times, okay? The bank usage of the Fed's backstop surpassed the 2008 crisis levels, and you see what happens here, right? In 2008, it was an inch up, and then it was a spike. This time, you just got all spike right from the get-go. There was a little inch up here ahead of time, right? For those in the know, if you saw that acceleration, you might have said, hold on a second, man. The data also showed $11.9 billion in borrowing from the Fed's new emergency backstop. That is the Bank Term Funding Program, which they launched on Sunday, and taken together, a banking system that is still fragile and dealing with deposit migration in the wake of the failure of Silicon Valley Bank and Signature. But boy, man, these are some numbers, man. And you better believe, folks, if banks are loading up their balance sheet with $150 billion, that they might see a problem in their own banks. And they're trying to shore up that liquidity. I'm sure that's the call they got from the Federal Reserve, right? Saying, listen, we cannot have banks failing left and right. That will create the contagion that they do not want to happen. And so they're loading up the balance sheet. But what happens if the run still exists? And that's the worry. What happens if First Republic's still down 20% on the open because investors are saying, hey, listen, it doesn't matter if you gave us $30 billion yesterday. We're still not confident that you are as secure as you should be as an FDIC-regulated bank with what's going on. Yeah, you want some volatility. How about those bank stocks, right? Let's check out the big bank stocks as we kick things off. Not normal stuff, folks. JP Morgan is right back to where we were at the start of action yesterday. Forget about yesterday. Yesterday's gone. Tomorrow's not here. What are you doing today, folks, as my dad would say? And yeah, forget about yesterday. JP Morgan right back to where it was yesterday morning. Bank of America right back to where it was yesterday morning. Goldman Sachs right back to where it was yesterday morning. Pretty remarkable. Morgan Stanley, pretty similar action, right back to where it was. It's going to be an interesting Friday, folks. We got 15 minutes to go until the opening bell. Markets in negative territory. S&P's off by 20. Stay tuned, folks. We'll be right back in 3 minutes. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We got the S&P negative by 23 points, trading at 39.71 right now. Let's take a look at some of these numbers here, man. I was looking yesterday. See how far I have to go back. Yeah, I think this is... So first of all, what's interesting here, looking at some of the trend lines we're dealing with, okay, we're going back in terms of the high, basically, February 14th in the market. And we are right towards the upper boundary line in terms of a trend line that we had. We hit the high in terms of March 6th. You're right back at that level right now. And boy, if we roll over, man, you're talking about a trend line that would bring you down pretty substantially in this market right now. Now, what you're also talking about, though, what's interesting is, first of all, from where this was on March 6th, okay, now I have to calibrate my brain to where March 6th was. Yeah, that was the Monday before Chairman Powell spoke last Tuesday, okay? Where did we just come up to, folks? The 618. We also came up to the 618, folks. That was right here where you had that consolidation from Tuesday, Wednesday, before things really fell off. Now, what's so remarkable here, right? What the market just did is it just got back to prior to the banking crisis, okay? All it did was it got back to where the market was trading at when Chairman Powell said that we're going to be higher than expected for rates. I don't know if it's a fair comparison, okay, but here is the other side of that argument. We got money everywhere. So it's quite a dichotomy in terms of, you know, the Fed's going to come in. Where does that leave inflation? Where does that leave earnings? Where does that leave their hiking cycle? But just like that, the market's basically trading where it was on, Wednesday before the Thursday of the collapse of the banking sector. Now, we're right at the 618 of this move from last Monday. But what I want to also look at, right, is I want to show you that we're also, okay, if you take the Fibonacci retracement from the highs in the market in the middle of February, you go down to the same area. Okay, and the 382 area lines up at a price point of about 39.80. So you have a nice area of confluence here that I did talk about in the program at some point in the past, that you have a 382 of about 39.80. You get a 618 of around, 39.95, 39.94, somewhere in that degree. And yeah, we got all the way last night to 4,009 on the S&Ps before you rolled over, but it's an interesting area in terms of that's where you get the acceleration to higher price. And just like that, we may be rolling over yet again. And boy, it is an especially interesting Friday. We're jumping all around, but you want to talk about interesting, man. You ready for this one, folks? It's options expiration Friday, and we got $2.7 trillion, a wall of expiring options. A worry for traders reeling from the bank crisis. You want to sprinkle on some volatility on a very volatile market? Well, add in triple witching. Yeah. Index rebalance set to spur trading volume. You ready for it, folks? It's coming. 2.7 million in derivatives contracts tied to stocks and indexes scheduled to mature today. So they're either going to have to roll them over, end them, or start new ones. The process usually involves portfolio adjustments that lead to a spike in trading volume and sudden price swings. How about that, right? Sprinkle that one on top of what we got going on today with the S&Ps down 20 points. Now, talking about the Fed a little bit, okay? So this is what we talked about in terms of the banks borrowing $164.8 billion from the Fed in a rush to backstop liquidity. Now, what's so interesting here, okay, is that this basically undoes all of their quantitative tightening for a long time going back. All told, the emergency loans reversed around half of the balance sheet shrinkage that the Fed has achieved since it began so-called quantitative tightening, allowing its portfolio of assets to run down in June last year. The central bank's reserve balances jumped some $440 billion in a week, which basically reversed all of the Fed's quantitative tightening efforts. Keep that one in mind when you're looking at the market, man. It's about in line with what we expected. That's head of U.S. economics for Bank of America Securities. Higher rates for discount window borrowing over the new bank term funding facility may reflect the broader set of collateral that banks are able to pledge at the window. Okay, so broader set of collateral, right? They're able to use more collateral in order to borrow money, which is the problem here because they have a real liquidity crisis. And that's, I was listening last, I think it was to Yellen, right? And what was she saying? That it wasn't a capital crisis because they have that on their books, but it's a liquidity crisis. They can't access that without losing money. Now, that's quite a conundrum because you can't access it without losing money because it's not worth what you say it's worth, right? That's the big kicker in all of this. But the Fed's emergency lending reverses months of quantitative tightening. Reserve balances with the Federal Reserve banks. You see the slow decline to around $3 trillion, and boom, just like that, all of it back in the balance sheet for the Federal Reserve. Yeah, and we're going to see where that plays out, man. But that is a big one for sure. Yeah. So Credit Suisse, jumping around to them, talking about the price of insurance. Now, this is part of the heat that Silicon Valley took, right? You could say that they made a bad trade. They did. You could have protected yourself if you were a bank from those types of losses, and you should have. Maybe if they had a risk officer, they would have, okay? But nonetheless, the cost of insurance against default on 10,000 euros of 5-year Credit Suisse senior debt, yeah, more than a 10 to 12% tax is what you're paying. And that's why Silicon Valley Bank didn't want to protect themselves at all. Because guess what? That costs money, and that eats into your margins, which eats into profits. But boy, you better pay attention, man, because the pain has not subsided yet. A 5-year Credit Suisse senior debt, 5 years? You're going to go 5 years out? What's the world going to look like in 5 years, man? Let alone by Monday, right? What's Credit Suisse going to look like by Monday, let alone you want 5 years of insurance, man? You better believe it. The other side of that is, would you be securing Credit Suisse? Now, 5 years is a long time, man, but it seems like their central bank isn't going to let them fail. So maybe they're thinking that the debt's going to be okay there because you're only talking about 1,000 to 1,200 euros to secure 10,000. But I wouldn't want to be on the other side of that. I'm not going to be the one risking 10,000 to make 1,000 on securing Credit Suisse debt right now with everything going on, because there's no way we know everything going on in the market right now, folks. The Fed's worried. The type of numbers we're talking about, okay? I mean, that number alone, when you look at that, banks borrowed $160 billion from the discount window. Yeah, that's quite a number, folks. And where did that come from? And why didn't anybody know about it 10 days ago would be the real kicker in this market as we look at it. All right, let's check around to some of the FANG stocks or tech stocks. Look at NVIDIA, man. You can't stop NVIDIA. They got an upgrade again today, I think, from 255 to 260 for NVIDIA shares. Amazon was rocking higher yesterday. I mean, the NASDAQ 100 is positive, man. You got the S&P catching a little bit of a bid. Amazon back over 100 right now. You jump over to Microsoft. They've been on a tear recently as well. What do you got? GPT-4 coming out, right? Microsoft going to be up another $2 at the open right now. But, boy, we talked about it, man. It's not hitting the banks. It's not hitting the financial sector. It's not helping out First Republic. It's not helping out J.P. Morgan right now. J.P. Morgan down another $2 as we look to this open. Yeah, it's going to be a spicy one. Let's jump to some of the other equities. I mean, everything was trading higher yesterday, man. Disney pretty much flat on the open right now. We jump to some of the ride-hailing companies. Uber barely in the red as we look to the open as this market catches a bid. Now trading at 39.78, only up 15 points. Dow getting hammered right now at the banks. Dow off 196. Yeah, and let's check out some of the commodities with crude sitting at above $68. But boy, pretty much at the lows of Wednesday. Yes, you got to 66, got to that 66 price point yesterday as well. But quite a week for the price of crude. Monday, remember, we were trading at $76 early Monday, man. We're trading at $68 for the price of crude, and we'll wrap it up in gold. Continuing to charge higher. Gold trading up $30, $19.53. Stay tuned, folks. You don't get many Fridays like this one. S&P's negative by 16. Coming back for the opening bell. Stay tuned.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. You're looking at an S&P negative by 10 points at 39.84. NASDAQ 100 barely in the red as well. Dow off 164 right now, and the Russell off by 15. Yeah, jumping around to some of the other stories. Let's check out how some of those banks are opening. First Republic in particular, man, they opened down 15.8% right now. Going to be an interesting Friday, man, to say the least. Options expiration. And yeah, how about First Republic execs selling $12 million in stock in the months before the crash? Now, my dad was talking about this on his show yesterday, man. Everything coming out of this. We're getting such an education in this market. Top executives sold millions. This is First Republic, okay? This is First Republic. They are still an active bank right now. Sold millions. The bank's chief risk officer sold on March 6th. 2 days later, Silicon Valley Bank, the chief risk officer. Okay, executives have been selling for months. You have the executive chairman, James Herbert II, sold $4.5 million worth of shares since the start of the year. All told, insiders sold $11.8 million worth of stock so far this year at prices averaging just below $130 a share. There's First Republic trading at $28 currently. Okay, the bank's chief credit officer, its president of private wealth management and chief executive, together sold $7 million worth of stock. Now, boy, you ready for this kicker of all? If you weren't listening to my dad's show last night, the executives' trades went largely unnoticed. Unlike insider sales at most companies, unlike insider sales at every other company in the S&P 500, is another way to say it, those at First Republic are not required to be reported to the SEC. SEC filings of insider sales are the ones that are scrutinized by investors, but instead, these insider trades were reported to the FDIC. A handful of banks currently file these forms to the FDIC, which posts them on their website. Okay, you can go through them one at a time is the deal. First Republic also publishes them on their website as well. As of Wednesday, okay, First Republic is the only company in the S&P 500 index that does not file its insider trades with the SEC. Do you know who else did that? Signature Bank, until they were kicked out of the S&P 500 last week. You can't make this stuff up, man. It has to go back to a Securities Act of 1933, which exempted banks from registering their securities with the SEC. Boy, insider sales, man. And it's especially interesting when you go back, right? And not to just dig Kramer all the time, man, but Kramer was pumping this thing when? In February, and you had insiders selling this thing all the way at the beginning of this year. Just goes to show, man, people in the know, be careful, folks, because somebody always knows more than you, and you see those executives selling. They were not numb to this risk, folks, okay? If they were numb to the risk, then they wouldn't have been selling at the beginning of the year. They were very aware of the risk that, guess what? At a minimum, their share prices were about to get pummeled, man, because at a minimum, they had assets on their books that were collecting 1.5%. And meanwhile, they were going to have to fight for deposits and pay a much higher rate. So their share prices were going to get hammered, man. That short seller that was huge on Silicon Valley Bank in January, I don't think he was looking for a banking collapse by March, but what he was looking for was investors to wake up to the fact that they were going to have some problems with their profits going forward, as everything that we now know was kind of present, and that was going to make it very difficult for them to make money in the future, let alone, what did it make it? It made it difficult for them to be in existence as a bank. So yeah, they don't report to the SEC, they report to the FDIC, insiders selling millions of dollars beforehand. And they're a big bank, man. And the market's saying, hey, guess what? You just got $30 billion in deposits, and we're still going to trade you down 20% on the day, as the day is not over, man. Let's check out Credit Suisse. Credit Suisse down another 6.2% so far today, off 13 cents, call it 14 cents at 39.80. All the markets in the red right now. NASDAQ 100 barely in the positive as we jump around. And yeah, let's see what else I had pulled up here. It's a lot of banks, folks. I mean, we got, they're all banks. That's what's going on right now. We're going to jump to FedEx. They get some big numbers in a moment. They're trading higher. But First Republic gets $30 billion. And guess what? Shares resumed sliding lower. Yeah, we talked about the $164 billion. Yeah, we've pretty much talked about the articles, and they all have to do with banking that we had up there. So let's jump around and see how we're trading to kick things off with the market in negative territory. Let's see how the big dogs are trading with Amazon flat on the session right now. Apple shares, slight give back. You're down by 0.3%. It's been quite a week for Apple, man. Monday, you were at 146. You just hit 156. This company's got 16 billion shares outstanding. That's 160 billion with a B, $billion in market cap. And let's jump back to the S&P, because let's see where levels we're looking at, man. I mean, yesterday's action, very easy number. We started at 3,900 on the dot, and we traded up to 4,000 on the dot. That was 1,000 points, folks. That's where I'm going to put it. And what do? We just hit your 382. Interesting. So we'll see if that does catch a bid as the market rolling over a little bit on the open. Let's put it on a 1-minute bar to see the 5 minutes we've gotten since the open. 9:30, you hit the high. From there, we get a little bit of a sell-off, man. Very interesting to see where big money is going, as in how do you position yourself on option expiration going into a weekend, man, where banks get $30 billion bailouts and trade lower by 20% the next day. Think about that, folks. Don't get lost in the shuffle. Things matter, okay? Things matter. And that was meant to shore up confidence. And I'm not so sure it's shored up, to put it lightly, right? Yeah, let's jump around to some of those banks and see how they do on the open. JP Morgan, man, down 2.5%. These big banks getting punished. Goldman Sachs down 2.7% right now. Yeah, they're all going to have to tighten, to say the least, folks. Now, what? Morgan Stanley and Goldman Sachs, I believe they gave $2.5 billion each to First Republic. You got JP Morgan. Was it Bank of America maybe? Citi. They're all down, man. It's just remarkable. They're all down pretty close. Look at Citi, down 2.63%. Bank of America, down 2.6%. It's going to be a wild open Friday, folks. And I imagine we're going to get two-way moves, because yesterday it was all about First Republic, $30 billion, the big banks coming together to bail them out. So you got the big banks kind of working with the government, right, to save the system. But, boy, going into a Friday, we'll see where we go as we're pushing basically highs, man. We're right where we were, folks, last night at, 3:15 in the afternoon. So we're basically pushing highs right now with the S&Ps only off about 10 points in this market right now. Pretty remarkable. Yeah, let's take a look at yields where we are right now. So you got the 10-year. You're under 3.5%, man, 3.46%. That's crazy when you look at it, right? The world can change very quickly overnight, and that's what we're all seeing, man. And how's this going to play out for inflation, man? We got a Fed meeting next week, right? What's going to happen in the Fed meeting next week? All right, let's take a look at some of the yield curve that we take a look at. And what do you got here? We got the 2-year sitting basically at 4%. We were just at 5%. Look at this. Yeah, we were just at 5%. You're back to 4%. And you got the 2-year back to where we were in September of 2022, man. You can't make that up. Remarkable. Let's take a look at the 10-year in terms of where we are. 3.5%. The 10-year was just pushing, 4.08% as recently as the beginning of this month. And we are back in the 10-year. Check this out. June of 2022. Absolutely amazing. S&P's off by 12. NASDAQ 100. Growth stocks charging higher. Positive by 13 points. Stay tuned, folks. We'll be back in 3 minutes.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Right now, negative by 12 points. You see the volatility. Just put this thing back on a minute chart. We just traded up to 39.90. We're trading at 39.81 right now on the S&Ps. NASDAQ 100 still barely in the positive by 3 points. But folks, it's Friday. It's options expiration, and we are going to get some volatility, man, today. I imagine with the VIX right now sitting still relatively low at 23.67. You think about what's going on right now in this market, folks. Exceptional times, to say the least. All right, let's jump around to some of the other articles I had pulled up reading this morning. Did you get some action in the SPY? Well, $7.3 billion. The single, in a single day into the biggest ETF, yeah, $7.3 billion is what you saw. Investors rush back into risk assets amid Thursday's stock market rebound. So you get $7.3 billion. That's into the $361 billion SPY, the most since a vaccine for COVID was announced. So right on par with getting a vaccine that saves the world, man. That's the same thing as we get yesterday. Not so sure that that's going to be the same deal, man. You're seeing the reaction today, folks, all right? I mean, is this time different? Yes. They're always a little different, but a liquidity crisis is the same thing as a capital crisis, except for the fact that it makes a bailout a little bit easier, right? Because if you don't have the money, then it's a lot harder to bail out the companies that will never have the money because they're never getting paid back for the securities they hold on their balance sheet versus the banks that are holding the highest credit quality out there, the U.S. government treasuries. So what's the problem here? The problem is they can't sell them, because if they sell them, then they incur the losses that will hurt their balance sheet. Well, yeah, we all know how that goes. That's an accounting game at the best. But yeah, you're talking about quite a pouring into numbers, and there was no sell yesterday, folks. Okay, so not surprising, but I don't know if that's how today's going to go. We zoom in on yesterday, man. 10:15 in the morning, you accelerate higher, and you didn't look back. Yeah, you traded down about 15 or 20 points. Not that much when you had a 100-point range yesterday. But today's another day, and you're seeing it play out with First Republic, and it was right after the bell, man. I had Bloomberg on 5, 6, 7 o'clock last night, I think. And I heard them already talking about, hey, what's going on with First Republic? You're already down after the market. Meanwhile, they just got $30 billion. And I said to myself, all right, it's not over yet. And it might take weeks or months to play out, folks, but the S&P's at 4,000. We have a Fed meeting coming up. They are going to hike by 25 basis points, okay? That's going to cause even further strain. Now, the most amazing part about this, though, is that it's not going to be too strained if you still got yields going down the way they have, right? What did we just show? The 2-year went from 5 to 4%, and we just had the 10-year go from 4.2 to 3.5. That's the strain on these businesses. I mean, take a look at the 3-year weekly, okay? To put things in context here, and this is the problem. They bought the 10-year at 140, folks. That's what they did. It's still trading at 115. Okay, so yes, there has been some easing in terms of rates going down. We have higher price and lower yield. Okay, you just went from a yield of 4.2 to 3.5% on the 10-year. But that was the problem when rates were at basically 1%. Rates were so low that the capital, right, the market capitalization of those investments, right, the mark to market is the best way to put it, of those investments, was so rate sensitive because they locked it in at such a low interest rate. As in, let's say you lock in a huge number at 4% interest rates, right? Well, if it goes up to 5, yes, it's a big number, but you went from 4 to 5, you're going to lose some capital on that. When you're talking about a number that's at 1% and you go to 5%, boy, you got to mark that thing down dramatically. So here's a quick example, okay? Let's say you invest. I better get this right in my head. I've done it before, but on the fly is a little bit more difficult, especially when you can't write things down. Let's say you invest $100, okay? And this is perfect. I got it in my head. Let's say you invest $100 and you're getting 1% on that $100. Follow with me, folks, okay? Because this is perfect, and this is going to illustrate to you how quickly, when you're at low interest rates, boy, you can lose a lot of capital, okay, as rates rise, and they mark to market your investment to correlate to the current yields in the current environment. Let's say you lock it in at 1%, okay? So you put up $100. That's the coupon. That's the face value. And you're getting a $1 payment every year, which is your 1% return. Now, to make things simple, let's say interest rates rise to 10%. Well, they just went from 0 to 5, okay? So that's not outlandish. Let's just say, for simple math, interest rates go, yields go from 1% to 10%. Well, you just paid $100 for a $1 payment. You're still entitled to that $1 payment. Well, if the market is looking for a 10% yield, what are you going to be able to sell that $100 fixed income asset for if the person buying it from you is demanding a 10% yield? $10, right? It's simple math. It's $10. If you want to get a 10% return on your money, and you're going to get a $1 payment every year, the market would be willing to pay $10 for what you just paid $100 for. Now, that's on the outside of the spectrum, but you can see how dramatically that rises, folks, okay, when you go from a number that's so low to anything that's so high, and that's what's happening. So we got decimation, man. You know, yeah, you've gotten a rise, but this is not relief when you talk about the numbers, man. That is 2020, okay? This is 2021. You really want the fair representation. That's when Silicon Valley Bank plowed money into the 10-plus year treasuries. Okay, so they bought them at 133 to get 1.63% for 10-plus year treasuries. 133. We're sitting at 115, folks. Okay, what is that? That's a, $18 loss on a $133 investment. You're talking about a 14% capital hit still at this number, let alone you were down at 108. And keep in mind the Fed is still going to hike. Just kind of going through the risk factors, man. Doesn't mean it's going to play out. But yeah, there are risks there. And boy, you know, one of the things as you really try and express how you can lose money in fixed income to people who are not in the market, it's one of the most important things you can understand about the market, folks. I heard my dad talking about it. I think it was one of the shows with Bestford he was doing a couple weeks ago. And Bestford says, man, you know, there's so many angles to this market, right? There's so many angles. And there are, folks. I mean, look at how this angle, it seems like an easy angle. It pops up out of nowhere, right? What he said is you got to focus on one at a time, understand each one, and you might want to start with bonds, man. And he's right. You might want to start with bonds because you understand bonds. It's a much bigger market than equities. And that's what drives everything. It's the cost of capital, right? It's the cost of capital. It's the cost of borrowing. It's the return that you're willing to pay somebody that's a saver. All of that is so important. And a lot of people don't understand. It's so difficult to understand how when yields go up, the price of what you're holding goes down. Because most people say, no, yields are going up. But remember, these are fixed. They're not variable. So yields going up don't affect you. I know you get it. But, man, if you understand that, it's just leaps and bounds so important in the market. And we're all getting a lesson of how important it is right now, man. Because this chart says it all, folks. And, boy, there's a breakout, okay? An ode to our man Bud Rolfs, the channel master. Love him always. And boy, that is a very clear breakout to the upside, folks. The tough part about this is why. What does that say about the market? Does that say that yields are about to crater because we have a banking crisis? It could. Does that say the Fed might be done hiking? It could. We're going to find out, folks. S&P's down by 20. Markets in the red. Stay tuned. One more segment. Don't go away.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got S&Ps negative by 17 points right now, trading at 39.77. Jumping around to some of the other articles I was checking out this morning. Can't read enough this morning in terms of what's going on. How about the ratings agencies, right? So interesting how this all unfolded. Silicon Valley Bank, Moody's, threatened to downgrade them. This is where it always. And this article talks about a little bit. I don't have enough time to go into it. Just in the bureaucracy that exists at some of these ratings agencies, that they just can't move quick enough to downgrade the equities that need downgrading as things are moving too quickly, because we know how it goes, folks. Things move very quickly. And what I don't understand about all this, right, is that Moody's saw it to some degree, because they told them, hey, you're going to get downgraded, man. Yeah, you have to raise some funds, shore up your capital. You're getting downgraded. Well, guess what? Silicon Valley Bank, they were in a tough spot, because they said, okay, if we get downgraded, that'll be a tough one. We might have a run on the bank. But if we go and we close out our losing positions, raise some capital. There might be a run too. They decided to do that. I think they went with Goldman for some help, and they failed spectacularly. But yeah, it's just over and over, man. Of course, 2008, it was a big beef because they didn't see anything on the wall. They didn't see it again. Nothing out there, and it seems like it was somewhat on the wall. Now, where does this go, right? You talk about some rewrites. It's going to be coming, man. Tiger Global, they write down $23 billion in value from its portfolio of startups. We saw how things were tough on technology companies that were public. The private companies are much more of a lag in terms of how they write things down. Tiger Global, $23 billion. They talk about in here, excuse me, what do they talk about? SoftBank, I think in here, they talk about, there it is, SoftBank, $48 billion Vision Fund 2 saw a 30% drop in valuations. So I wouldn't be so sure we're over the hump here yet. As, boy, especially interesting that we come into things on options expiration Friday, $2.7 trillion in options. You got First Republic down 17% right now. You got Credit Suisse down about 4.6% right now. You got the big banks down 2 to 3 to 4 to 5% right now, with the S&Ps off 18 points. Thanks so much for starting your trading day with me, folks. Stay tuned. We got our man Basil Chapman. He is coming up next. Steve Rhodes, Fast Market, live programming all day, folks. Thanks for starting your Friday with me. It's going to be an interesting one. Stay tuned, folks. Have a great weekend. We'll see you back here Monday. Stay tuned for Basil. He's up right now. Thanks, folks.